I'm with Brunno Maradei, the Global Head of Responsible Investment at Aegon Asset Management. Brunno, thanks for being with us. There's a lot of talk during the crisis of ESG being at a tipping point. But what does that mean in practice?
Well, I joined the industry 16 years ago now, and back then, we were really a quirky niche way of investing, largely confined to charities, endowments, and a small minority of retail investors, let's say. And that was reflected in the industry structure back then. We were all small, sometimes non-profit research providers. It was small funds, mostly in the retail space, often run by specialist managers, particularly in the US. Everybody used relatively simple approaches like exclusion. And I recall quite a large number of client meetings when I used to head up the client team at Iris, where the team used to come back from the city and express huge frustration at how they were treated. And when they were trying to break new ground with the investors, it was a really tough market. And fast forward to today, I think the industry is completely unrecognizable, right? We've got big names dominating ESG research now: MSCI, Moody's, S&P, Morningstar. Most of the RFPs that we get from potential clients ask increasingly complex and in-depth questions about our approach to ESG. Clients demand ever more detailed ESG reporting, even when their mandates don't say anything explicit about ESG. Companies globally are now expecting to have a normal dialogue with investors on ESG. And in the most advanced markets, even politicians and regulators are actively encouraging or even demanding our position and involvement in key ESG issues. Even the SEC is thinking about regulating sustainable funds. 1,000 flowers have bloomed in terms of approaches as well. In the early years, ESG was all about equity investing, right? Now it's pretty conventional to apply it in fixed income, and we're already looking at ESG in alternative credit, in real assets, and in asset allocation as well. Alpha is being actively pursued with ESG insights now, and the industry is refocusing to what is the point of all of this? What is the impact? And that's exactly why I left the industry, say 12 years ago, 14 years ago, maybe. I went to development finance to indeed be able to see that impact better. So I'm really happy to see that now the asset management industry is really following suit and really focusing on the impact of its actions, impact of responsible investment. And I think the tipping point is behind us already. I mean, I think responsible investing is now an avalanche. It's exciting, but it's also a bit daunting.
So there's a lot of talk also about long-termism, but it strikes me that the market can only behave in a short-term manner. Is that correct? And how do we rectify it?
Well, I'm a strong believer in individual responsibility. But there's lots of different contributing factors, I think. Incentives, obviously, the most obvious ones. They need to be tackled head on. There's a strong movement, as you know, working towards it. Compensation policy is probably the biggest area of engagement for most investors. And in the investment industry itself, it's slowly moving away from short-term incentives, right? But even back in 2005, I recall a big client of mine already talking about implementing 3-year rolling performance targets for its fund managers. But as 3-year targets, are they long-term enough to deal with issues like climate change? Arguably not. We haven't cracked that nut yet, and I don't have an answer on that, really, how to implement incentives to cover such long time horizons. My sense is such big long-term objectives like climate change mitigation can only be achieved through regulation and public sector intervention. The private sector practically can only go so far in its time horizon, right? It's all about when are you drawing down that college fund or your retirement or the dream house that you want to buy. Climate change is an intergenerational issue, and as such, regulation is key to getting the right outcomes, which is why I think the EU drive to regulate and standardize sustainable finance is sensible. I mean, extrapolating from their current status in the direction of travel, I can see a future where long-termism will be baked into European credit markets or capital markets more generally. How that will interact with trade, development, and competition policy remains to be seen, though. This will be a big challenge to overcome in the years to come as we start to feel the effects of sustainable finance regulations and we start to fully study them and understand them. I mean, aside from incentives, there's other things that contribute to short-termism, right? I mean, uncertainty about the future is one that, it's a big one, I think. Many millennials tell me today that they don't even believe they'll have a pension no matter how much they save today. How can we improve their sense of long-term financial security? I think this might be one aspect of Nordic and Dutch cultures that contributes to their faster adoption of responsible investment, for example. The fact that they feel a bit more secure about this long-term horizon. Another big thing to tackle is education, information, and trust. I mean, the speed of change is crazy now, right? It keeps increasing for all of us. It's hard to keep up. And so we've got more information than ever before, but whose information can you trust? Can I really trust the company's energy transition plans? How can I distinguish a true long-term thinking company from the rest of them? These are tough questions to address. And then there's the issue of unexpected shocks, right? I mean, we're living one right at the moment with this global pandemic. I wonder how many of us have thought about that trip that we've always wanted to take, or that car that we always wanted to buy, but we put it off to save for retirements. Yep. And so I think there is a fine balance there between being shocked into positive action to mitigate long-term risks and feeling completely hopeless and deciding not to bother even trying. So I worry about this possible flip side to the COVID crisis, with so many of us facing our immortality, the loss of our livelihoods or savings. When we come out of the crisis, are we really going to move away from reliance on fossil fuels or work towards mitigating the next crisis? Or are we going to feel completely hopeless and traumatized and choose short-term gain instead again? So that's a big worry we need to think about in the industry.
So in that context, what are you telling clients, or what are clients asking you?
I mean, for us, the message is consistent. There is alpha to be gained in ESG. That's our fundamental belief. And there is real impact too. But I think real ESG value, you can only really achieve it through active management. You've got to develop your own ESG opinion holistically with your financial analysis and align it with your view of the world. Sustainability research, ESG research, because it's largely based on disclosure still, it suffers from consistency and availability issues. We are starting to see even passive ESG products deliver some value, but I would argue that most of that value is in the under-researched parts of the market, which is not too different a story for when we talk about uncovered bonds or undercovered bonds or undercovered stocks in terms of research, right? But in the ESG space, it's exacerbated because ESG disclosures are not mandatory and they're not standard either, right? I think the quality of the managers that you pick is still are absolutely paramount. But ESG alpha appears even in the average performance analyses, right? John Hale at Morningstar just put something out showing that 70% of sustainable equity funds ranked in the top halves of their categories and 44% of the best quartile, versus only 11% in the worst quartile. That's 4 times more sustainable funds finishing in the best quartile than the worst. And a lot of this performance premium, a lot of naysayers might say, well, it's just because, these ESG funds are underexposed to the energy sector, and we've seen the energy sector crisis at the moment. Nevertheless, I think that's still a good ESG bet. I mean, if you bet against the energy sector, that's an ESG bet in my view, and that's a good bet and it should be recognized as one.
Absolutely.
But I would also argue that some of the outperformance is attributable to how these ESG factors help us select the best managed, more resilient companies in the long term. I think some of that performance gain is to do with that as well. I mean, at Aegon, we've really thought about this long and hard. And so we've developed our own proprietary ESG categorization as part of our fundamental credit research process. We're systematically rolling that out globally for all our investment decisions. This proprietary holistic assessment of all the aspects of an investment, financial and non-financial, backed up with an active approach to ownership, allow us to generate a better financial return and lower risk as well. And then when it comes to impact, I'm pretty old school. I've spent over a decade in development finance institutions after I left Iris. And I still believe that to deliver real environmental and social impact, you've got to be an active investor and do your homework, right? You have to have a credible additionality too. What does additionality mean? That for us, it means playing in private markets. It means playing in primary markets, in alternative credit, in real assets. If you're playing in secondary markets, I think you still have very good impact, but you have to really use your voice as an investor to move the companies you're investing in. And so for us, we're pushing both ways. So one example of that is On the investment side, we are a Dutch subordinated loan fund. We use a first loss guarantee from the EU, so it's a blended finance solution to participate in high return loans to small and medium companies that are financing really innovative projects. So it's a job generation story, there's an innovation story there as well. And then for the conventional bond and equity funds that we have, we're very active owners, right? So that's where we try to achieve impact. So last year, we really stepped up our engagement. We went up from 360 to 560 companies last year. And when we talk to companies, because we're mostly fixed income investor, we're agnostic whether we hold equity or debt. And usually companies don't even ask us, to be honest, whether we hold equity or debt. Companies are used to having this conversation now with all kinds of investors.
Interesting.
And our response rates are actually quite impressive. 60%, over 60% we're in a dialogue with. Given our size, that's actually pretty good. Now, even our progress has been noticed because we're starting to be approached by third parties now asking us to engage on their behalf. I think for us, just getting the right talent to talk to companies and having that two-way conversation that companies can feel really deliver value on both sides is really, really important if you want to achieve impact with engagement.
So where do you see the industry after this crisis? Assuming we get through the crisis, what does the asset management industry look like?
That's a really difficult question, isn't it? I mean, I've worked in the industry, in the finance industry for over 20 years now, and I've spent some time with the biggest names, JP Morgan, Morgan Stanley. In the last 20 years, we've seen the big get ever bigger because of fees reducing and smaller players, struggling to remain competitive. I think asset management used to be a relatively complacent about demonstrating its value to clients 20 years ago. So the silver lining to this transition that we've been seeing is that that's no longer the case, I would say. The asset management industry is ever more responsive and competitive, ever more focused on demonstrating precisely the value that the active management fees can bring to clients. And alignment of performance with compensation is going to continue for sure, and we all have to be very well positioned for that. I am, of course, biased, but I believe a critical component of value that we bring to clients is in assuring their capital is managed responsibly, in line with the objective of achieving long-term sustainable returns for their future in a world where they can still breathe the air, where they can still drink the water, and where their streets are still safe. And for me, COVID really highlights this responsibility, right? We have research already showing the effect of air pollution on the ability to recover from the disease. So an interesting question comes up: what would the death toll look like in a world where we didn't have diesel cars or coal-fired power plants? How many of the elderly that are currently dying have made full use of their retirement funds that we provided for them? We focus so hard on providing these retirement funds, but all of a sudden we have this crisis there and they can't even benefit from that. I mean, at the same time, COVID brings us a glimpse of what stranded assets really looks like to markets, right? I think that's super interesting as well. It's a very literal demonstration of that in the negative futures that we saw for the WTI, right?
Yeah.
Oil was literally stranded without storage capacity. And it makes you think how many more such shocks might be in store. Are we spending enough time looking at these issues, even if you explain it away with unforeseen demand collapse and geopolitical issues causing the glut, still, are we prepared enough to see the future shocks? And even if you walk away from stranded assets on the financial materiality side of things, I think COVID also highlights the ability of ESG factors to help us better understand corporate resilience to these shocks, right? We can see that in the performance analysis already. Even in the passive funds, you see that the ESG indices are outperforming the conventional parent indices. So that's quite an interesting observation. ESG is really helping to pick the best stocks in this case, but also high yield bonds, I'd say, are quite affected by it as well. I think overall, if we do a good enough job of making our clients feel empowered to tackle these trends and risks, then I think, I see us becoming ever more aligned with a long-term outlook and achieving more positive social and environmental impact. I mean, if we fail as an industry, then we might see significant asset outflows, and we'll continue to see our share of total assets that we manage as an industry decline, as well as possibly a return to short-termism. I think it's a challenge that we all have to embrace. We don't have any choice, and I think we're ready for it, though. Overall, I'd say I'm an optimist.
That's a great note to finish on, Brunno. Thanks so much for your time.
Yeah, thank you for having me.